Good morning, ladies and gentlemen. Thanks for joining us today. Hope you're all doing well. Today we're going to be kicking off our webinar, second session in our webinar series. So on behalf of Slattery Asset Advisory and Slattery Options and Valuations, it is my absolute pleasure to welcome you here today. I'm pleased to share that we've had over 150 registrations for today's webinar. We've got a few questions that have been submitted earlier. So we'll try and answer some of them and get to that. So today my name's Adrian Wong, I'm the General Manager of Valuations. Today I'm joined by Bruce Tykett, National Manager, Insolvency, Banking and Finance, James Rouse, General Manager, Queensland, and Aaron Smith, Business Development Manager and Valuer. So today Bruce will be talking about the road transport industry, James will cover off on agriculture, Aaron will be looking at aviation, and I'll finish up on the automotive sector. So we will be referencing key points in our webinar that is available, key points from our quarterly report that's available on our website, and we'll be sending a copy of this presentation to all those who have registered. So thank you for joining us. I hope you enjoy it, and I'll now pass on to Bruce to touch on road transport. Thank you all.
Thanks, Adrian. Welcome everyone, and it's great to be back. I can't believe how quickly the last few months have flown by. Before I kick into the road transport space, I just thought I'd take you back, and as Adrian mentioned, today we're going to be covering the period from April through to June, which was in our quarterly report, but we're obviously going to touch on some of the trends which we've seen since then as well. So just casting your mind back to the second quarter of 2020, obviously COVID was front and center. It's the elephant in the room. You know, that comment, they're the new normal, it was on everyone's lips, and everyone was signing off and saying, instead of saying take care, everyone was saying stay safe. But there was a lot of uncertainty on the back of COVID. We weren't sure whether it was just going to be a flu or whether it was going to be a full-blown pandemic. It's obviously gone with the latter. And that uncertainty really transpired into the plant and equipment space, and we'll be obviously touching on today. Confidence was down, and we just weren't sure what was going to actually happen, where we were going to be, you know, and things were really on the move. The government obviously jumped in, and they really supported the Australian public with things like JobKeeper and JobSeeker. But again, people in those early days just weren't sure what was going to be the knock-on effect and where we were going to be. There was obviously a couple of things closer to home in the plant equipment space which had a real effect on what we were doing, and that's the instant asset write-off provisions. They started out at about $30,000, and they've been increased to $150,000. They were extended just recently to the 1st of December, and they really did have a huge impact on what we were seeing, particularly in the secondary market for plant equipment right across the space. So moving on to transport, what were the key trends? You can see some high-level numbers there about where the industry was going, but as we've discussed before, road transport really drives Australia, and it was deemed an essential service. So there was still a lot of activity in that space. Last time we mentioned that there was a fair bit of consolidation going on, and that continued, particularly in the small and medium-sized space. But contrary to that, there was a recent announcement that the largest player in the Australian transport industry, being Toll, owned by Japan Post, was potentially going to be sold and broken up. So it's a bit of a watch this space on that side. Other things which really affected the transport industry was the factory shutdowns. Volvo and Kenworth, the two operators in Australia who manufacture here, did reduce their capacity around that uncertainty as to COVID and what the demand was going to be. In some cases, we've heard that they dropped their production by around a half, and that has had an impact on what we're seeing, particularly in the secondary market and filling that gap which the new trucks left. But the key thing which we've also seen has been driver demand. That seems to be a theme which is carried through from 2019, and it's still really prevalent. And that driver demand has actually risen, particularly in the small to medium space as well. If anyone's house is like mine, the number of online package deliveries has absolutely skyrocketed, and that's had a real impact on what we're seeing in the secondary market. Starting with the new sales, you can see here that there has been a bit of a drop, around 40% on what we were expecting, and the light duty and the heavy duty trucks were the ones which were most affected. Medium duty, not so much. To give you a little bit of context, at the beginning of the year, they were predicting about 14,000 heavy duty truck sales, and now we're on target for about 10,000. So that's had a huge knock-on effect, because while the supply is down, the demand has really normalised, particularly as we've headed into the third quarter. Going back to April, we saw a real drop of around 20 to 30% in sales, and that continued into May. But there was a little bit of a normalisation and an uptick on a year-on-year basis, with June sales increasing by about 13.5%. So that was when we started to see JobKeeper and JobSeeker really come into play, and people gained a little bit more confidence while people went with the money coming into their bank accounts and seeing that those subsidies, which the government put in place, was actually going to come through. But just to give you a little bit of context, there's been a few questions about delivery times, and these are recent figures, so not in the second quarter. Kenworth, for a standard Kenworth, is around three months. And while I mentioned that they did drop their production, they're almost back to normal. They've ramped up production. The new build time on Volvos is around 6 months, and a little bit longer for your Western Stars and your MANs. So where is that gap being filled by? It's being filled by the secondary market. Isuzu is another player which we've seen a fair bit of movement in, but they are telling us, and we've seen the number of trucks still available, particularly in the heavy duty and the medium duty space, and they're available now. The biggest limitation you'll have with Isuzus is actually the configuration of the component which you're putting on the back of the truck, and actually producing that is the biggest limiting factor. So that leads us into the secondary market, and it really has been filling that gap left by the new truck sales. Demand is still there, and if you've got a lead time of 6 to 8 months to actually get a new truck, and you've got a contract which you want to service now, there's only really one place which you can get that truck, and that's coming through an auction or the secondary market. The sales have been really strong, and right across the board, the feedback which we've been getting is that people are either upgrading their fleets or they're actually adding to their fleets with what's been happening on the back of COVID. The results which we've seen right across the country have been really, really strong. The clearance rate at auctions are right up. And one of the biggest challenges we've got at the moment is actually to get our hands on new trucks, because as soon as we can get a truck, there's a lot of interest, particularly later model. You can see there that in Victoria, we've seen some really strong results, particularly in the European space, while New South Wales has followed that trend. One of the really interesting facts is that we used to see a bit of a drop off around the 6 to 7 year old truck mark, but that's really come back, and again, filling that gap which has been left by the new truck market. I touched on home delivery, and that market again has been one which has driven a lot of demand. Just on these next two slides, you can see some of the recent results we've got. And what we've seen at auctions is a lot of the key players, particularly the industry participants, have been telling us that the results which we've been getting at auction have been actually exceeding what they've been seeing on their truck yards. And they've actually absolutely been blown away by the results. As I mentioned, these figures are from the second quarter, and it's only become stronger as we've moved into the third quarter. Moving on to the trailer market, there's been a huge demand right across the board. It doesn't really matter what capacity or configuration you're talking about, the demand has been strong. One of the key factors, apart from COVID and JobKeeper and the like, has been the agri buyers which have come into the space. They've really driven up prices, and we've seen an increased participation rate by regional buyers in this space. Victoria, just as an example, has got a bit of demand on curtain siders, and recent feedback we have got is that curtain siders have about a 3-month wait time. We've actually got a sale on Waybush trailers at the moment, which is probably a lesser known brand. But again, the interest in those trailers has been really strong, and we'll obviously report on that in our next quarterly report. So just handing over to Adrian now, and I'll hand over to him to introduce James Rouse. Are there any questions at this point?
Yeah, thanks, Bruce. Appreciate that overview. So we do have a question from the audience. Just curious, who's leading the race for new truck sales in the heavy duty market at the moment, please, Bruce?
Yeah, okay. Yeah, great question. It's obviously it's really neck and neck at the moment. So just for everyone's edification, your heavy duty market are trucks which have a GVM or gross vehicle mass between 8 tonne and 39 tonne. So the larger trucks which you see obviously doing the runs up and down the freeway. At the moment, Volvo are actually leading the charge. They're about 1% ahead of Kenworth, and these are numbers up until August. And Isuzu are third in that market. When you talk to the Volvo guys, they always like to add in that they've obviously got the Mac product as well. So when you add that in, they're sitting at around 26%. So yeah, hopefully that answers the question. And now I'll hand it over to you.
Yeah, good stuff. Thank you very much, Bruce. We're now going to introduce James Rouse, General Manager Queensland, who's going to be talking to the agricultural industry. Welcome, James.
Thank you very much, Adrian. Well, as Adrian said, I'll be giving a short update on the state of the agricultural market in Australia as we see it. And what I'd like to do is start off with a quick overview of the key economic and other drivers for the sector. There are two key factors that affect the agriculture industry in Australia. Those are rain and strength or weakness in the Australian dollar. Generally, the drought that affected large areas of Australia's productive agricultural regions has broken with good general rain early in the year. The Bureau of Meteorology is forecasting above average spring rainfall for most of Australia, with the noted exception of Western Australia. However, widespread rain in the Western Australian wheat belt regions in August has potentially saved the state's grain growers from a looming disaster. The forecast wheat crop for Australia is around 25 million tonnes, and whilst this is well up on the past 3 years, it is around about the long-term average. The Australian dollar has appreciated significantly against the US dollar since April, from around 57 cents to 73 cents in September. Much of this strength does relate to weakness in the US dollar. However, China's demand for Australian resources for its industrial and infrastructure-led recovery will likely put further pressure or further upward pressure on the Australian dollar, which is obviously bad news for exports. And whilst the high dollar is bad news for exports, it's certainly good news for new machinery purchases with cheaper imports. Off the back of the strength in the Australian dollar, commodity prices, with the exception of beef and sugar, have fallen sharply over the past 3 months. As an example, wool prices fell 12.8% in August and wheat fell 8.2%. Another risk to the sector as a whole is the current uncertainty in relations with China. Recently, China imposed anti-dumping and anti-subsidy tariffs on Australian barley, and this that really does threaten an export market worth around $600 million a year to the economy. In the new machinery market, the machinery market and agriculture in general has been less affected by many other industries by the COVID-19 pandemic. Contract harvesters and farmers are concerned by the border closures, as this will potentially restrict movement of itinerant workers between states, which may result in a shortage of backpacker and itinerant labour at harvest. In the new machinery market, we've seen combine harvester sales steady, with most product now in place for the 2020 cereals harvest. However, full year sales will likely be down 15 to 20% on last year. As the June quarter came to a close, new tractor sales exceeded 2,000 units for the first time since 1981, which is certainly a significant uptick. Tractor sales for April represented a year-on-year increase of 40%, and another 30% for May. That trend really has continued into the spring, with sales continuing to soar with a 19% increase in August. The key drivers are the seasonal conditions off the back of drought-breaking rain, and the instant asset write-off scheme has had a massive influence. The increase in sales is also mostly attributable to tractors under 100 horsepower, with sales of tractors over 200 horsepower actually down 7% year to date. Conversely, sales in Western Australia across the board were actually down 2% on sales in August 2019, and this is primarily due to the reduced demand for those large 200 horsepower plus tractors in the broad acre sector. Supply of new equipment is becoming an issue, with some product normally expected ex-stock becoming subject to 8 to 10 week delivery times. In the second-hand market, whilst the market for second-hand agricultural machinery was generally strong, there have been some mixed results around the country. In Queensland, our secondary assets have sold very well, including older, less productive machines. Agricultural equipment differs from construction equipment, for example, in that farmers can obviously get away with using older equipment, whereas the construction industry, for example, equipment generally needs to conform to current WH&S and emissions requirements. Sale results for second-hand assets can also be very seasonal. As an example, a combine harvester is far less saleable in January after harvest than in July leading into harvest. And I'll just quickly run through some sales we achieved in a recent sale we ran in the Guida Valley in northern New South Wales and the Southern Downs centred around Goondiwindi in Queensland. These sales occurred in July, so they're very recent sales. We sold a 2011 class Lexion 740 combine harvester with a Macdon front, 2,414 hours. This machine sold for $141,250, which we believe represents around about 100% of retail. We actually sold two of those, two very similar with similar hours for around the same sort of money. We also sold a 2014 Gold Acres G4 self-propelled sprayer, and that's actually a picture of the unit you can see in the background of the slide. This sold with 5,083 hours, sold for $115,500, which we believe represents around about 95% of retail. In the same sale, we sold a 2011 Case Magnum 315 FWA tractor, 5,500 hours. This sold for $97,500, which we believe is around about 90% of retail. So basically, the outlook for the rural sector or the agricultural sector is very, very positive. We're seeing good rainfall throughout 2020. The 2020 harvest is looking very strong, and obviously we're well into the calving and lambing seasons, and there does seem to be an abundance of feed in most of Australia's agricultural regions. So, Adrian, thank you very much. Do we have any questions before we hand over?
Yeah, thanks, James. Really handy insights into the agri market. We do have one question that's come through, just in relation to stock numbers. How's the recent drought affected that, please?
That's a very good question, Adrian. Australia's sheep herd presently sits at around 68 million. This is down from about 74 million in 2018, when the effects of the drought were really starting to bite. Longer term, however, we're well down on our numbers from the early 90s, where Australia's sheep herd was around about 163 million. With regard cattle, the cattle herd hasn't been so affected, dropped to just under 25 million from just over 26 million in 2017, and a recent high of 29 million in 2014. So the cattle herd certainly hasn't dropped to anywhere near the extent of the sheep herd has in Australia. I think primarily that's due to the high cattle prices we've been achieving, as opposed to the wool and lamb markets, which have copped a bit of a hit.
That's great. Thanks, James. Appreciate your insights. I'd now like to welcome Aaron Smith, who's going to cover off on the aviation industry. Welcome, Aaron.
G'day. Thanks, Adrian. Morning, everyone. I'll just be discussing the aviation sector and sort of what we're seeing, which a lot of this stuff you've probably already heard via the news or via papers. So it has been very topical, and it has very far-reaching concerns as well. So worldwide, there's over 16,000 aircraft currently grounded, which is about 2/3 of the global fleet. So it's not an insignificant amount. And in terms of passenger numbers, obviously has a correlation. So US air travel, for instance, is down 95% for the month of June compared to year on year. And globally, that number is about 63% for the same period. So while everyone else is grounded flights and airlines, it is important to note that it's been reported that China has actually increased their flight schedules and are actually reported to be back at pre-COVID levels, and with a view to actually start opening up more international routes. So one to watch there. Passenger numbers in Australia have actually, international numbers arriving into Australia has decreased by 99% for the June month. And domestic travel into Sydney Airport is actually reduced to 10% of the same period last year. So, which is to be expected with border closures during early parts of COVID. The reduction in flights, obviously, for international has had a massive effect on the global freight network, with delays of goods and services being imported and exported. And anything that needs to come from overseas has obviously got a long delay. I'm still waiting for something myself. As a result, demand for cargo aircraft have actually increased during this period, and airlines have actually retrofitted some of their aircraft to be able to carry freight in the main cabin and utilise some of that fleet that is currently grounded. So in terms of the big players, obviously in Australia, you've got Qantas and Virgin. I'll start with Qantas. Obviously, they've made a lot of public announcements about their fleet and their staff, with 6,000 jobs being made redundant and expected to be some more in the process. They also announced a $1.9 billion statutory full-year loss, and as a result of COVID and the staff being laid off, Boeing have also retired a lot of or stored a lot of aircraft. So Boeing 747 have all been retired now, never to be seen again from an Australian operator. All the 12 Airbus A380s have been sent to Mojave Desert for deep storage and not expected to come out for another 3 years. Boeing 787, there's a number of those that have already been sent over to Mojave for deep storage as well. In total, Qantas have grounded approximately 100 aircraft, so quite a sizable number of their fleet. In regards to Virgin, this is it's been in the media obviously a lot. So Bain Capital has officially been confirmed as the new owners of Virgin at the second creditors meeting earlier this month. This announcement obviously provides certainty to the general public, staff and stakeholders. It also ratifies the plan to downsize the aircraft fleet from having multiple aircraft to Boeing 737 only fleet for the foreseeable future. And obviously has the consequence of the number of aircraft being returned to lessors or sold. And of that, the Boeing 777s, Airbus A330s, and the ATR 42s and 72s. So it's important to note, though, that however, while Qantas and Virgin are actually got a number of aircraft that are grounded, airlines such as Regional Express and Alliance Airlines are actually increasing the routes. So some of the routes that they have taken up are either lucrative, such as Brisbane-Moranbah, competing with Qantas, or some of the routes have been vacated, such as Brisbane to Proserpine, for instance. So they are also looking to move into the East Coast market, so Brisbane, Sydney, Melbourne. So they may pick up some of that market share there. And obviously Tiger Airlines has officially closed, which is no surprise to anyone. In terms of the tourism market, tourism aviation market, with no international visitors, border closures and the lockdown obviously in Victoria, tourism numbers in Queensland, Northern Territory and Western Australia have decreased significantly. So this has put some aviation operators into a bit of distress, but given the fact of the government stimulus, it has provided some support. So without borders opening and if government stimulus comes off, then this will be one market to watch. Flight schools are obviously another interesting point. They have been operating to some extent during the COVID and some of them actually been operating as normal. However, flight schools with an international focus or international cadet focus from some of the major airlines may find capacity into the future as it's expected that some of the cadet programs may be minimised because at the moment we obviously have a surplus of pilots out of jobs and out of work. So training for new pilots may not be top of the priority at the moment. So this oversupply is obviously something new, whereas before COVID, there was a pilot shortage and an expected pilot shortage to last for a while. However, there is an expectation that demand will come back, however, may not be for several years. In the general aviation sector, so 4-seater, 6-seater aircraft, private aircraft, there has been some movement, which with well-priced aircraft and helicopters selling relatively quickly. So we've received some feedback that people who are going to spend money on lavish holidays or overseas are actually putting it towards either flight training themselves or buying an aircraft or upgrading the aircraft that they've got. So there is a bit of market movement in there, but there isn't enough at the moment to see which way the trend is going to go in the long term. So looking forward, the corporate travel is another big one, especially on the East Coast. Sydney to Melbourne is the fifth most productive route worldwide. And so as companies look for an alternative with lower capacity aircraft, private aircraft or corporate aircraft may actually come into play. It offers flexibility flying from Essendon Airport to Bankstown and either hiring aircraft or using a subscription-based service where they pay a yearly fee and obviously higher rates on top of that. But it is an option that is moving forward, and it's expected that this sector of the aviation may actually increase. And as I mentioned, we're unsure the full effects of COVID haven't obviously been felt, so it is something that we're looking to monitor in the future, and we may not see a change or enough data become available to see the true trend or extent of the COVID effect until sort of sometime next year. Thank you. Back to you, Adrian.
Thanks for that, Aaron. We do have a question, if I may. So just in relation to helicopters, in particular the Robinson R44s and R22s, you got any intel on that, please, Aaron?
Yeah, absolutely. Thanks, Adrian. The Robinson R44s and 22s are a very versatile aircraft, and we have seen some transactions of these. And because they're used in the agricultural mustering applications for the R22s, there is still strong demand. And as we know, farming hasn't been completely affected, so this actually provides some demand, and it's expected to stay buoyant for the next sort of 6 months. So there is still a strong sector of the market, and expected to be for a little while. Thank you.
That's great, Aaron. Appreciate that, your insights. Thank you. Alrighty, so looking at the automotive market. So in summary, this market is struggling, particularly the new car sales. So what we did see in June 2020, sales were stronger than expected, but it's similar to other industries. April and May really struggled with the coronavirus and were heavily impacted. So the drive in the June figures, we put that down to some easing COVID restrictions, the instant asset tax write-off that we talked about, and easier access to super funds. So the buyers had been coming back in June. Whilst there was a little bit of a rebound, it's still worth noting that June was the 27th consecutive month where sales have been negative, year on year. So that's the longest slump since the GFC. So it's still a bit of a concern. In terms of numbers, there were around 110,000 vehicles sold in the month of June. At the moment, we are seeing manufacturers a bit worried about stock shortages with global production slowing down and restrictions, with transporting some of these goods. So people have been talking about this V-shaped recovery, and whilst we did see a little bit of bounce back in June, I think it might be a bit more of a tilted L shape. So we really need to watch this space. So continuing on, anything relating to the building and construction industry has been pretty strong. And as Bruce mentioned in his presentation, think about the number of vans running around, people sitting at home doing a bit more online shopping. I think there's packages arriving all over the place. It's like Christmas has come early. Commercial sales were up by 8.6%. So again, that industry is going pretty strong. Having a quick look into the July period and the quarter. So new vehicle registrations were down nearly 13%. And the market's still overall down about 19%. Just want to have a look at the new car sales figures here, and looking particularly at the number one. So Toyota was the best performing vehicle in terms of new sales. They were actually up nearly 8% in June. And looking at the figures there, they sold nearly 23,000 units. Just a bit stark contrast here. When you look at Mazda, they came in second at 9,400. So sold less than half the amount of cars than Toyota, just showing Toyota's dominance. And you can see Hyundai third there with nearly 8,000 cars sold. Moving on to the secondary car market. So April and May, the secondary car market really struggled. That was tough, and inquiries were down, clearance rates were down. So that struggled. In terms of bounce back in June, we did see that. And again, similar to some other assets with the government subsidies, people are taking advantage of that. So secondhand cars have been really strong. That's actually driven prices up. We've seen some of the prices increasing around 10 to 15% since May. So good recovery there and quite strong. So as I mentioned, some of the super payments and people making more frugal choices in terms of their vehicles. I know I'm talking to people in the industry. There was periods there in Queensland for whatever reason, not for whatever reason, but just in Queensland particularly, you couldn't get a vehicle around that $10,000 mark. So people were stripping out the super and looking for that second car. In our last webinar, we mentioned, or we were thinking that what could drive to the second-hand car market, people avoiding things like public transport, ride sharing, that sort of thing. So that seems to have come to fruition. I touched on the new car sales stock slowing down from overseas, new car sales slowing as well. So this means by virtue that the dealers don't have many second-hand cars on their lots as well. So they're looking to bulk up that bit of stock. Just as a bit of a barometer and a guide, so car sales normally has around 220,000, 240,000 cars on the market at any given month. This had declined down 161,000. So this just really reiterates that shortage in supply in the market. Again, similar to the new car sales, sorry, just on this point here, the wholesale buyers, again, people are struggling to get stock. You know, our yards are emptier than we would like them to be, and that is translating into higher option clearance rates and also prices. Again, with the building and construction industry, commercial vehicles still remain strong. So last webinar, we mentioned the flight to quality. So people are looking at, you know, the Hiluxes and the Amaroks, any good vehicle that going for really good prices. So just in terms of a bit of an outlook here, there will be a little bit of volatility, not too much, but just those supply and demand factors, depending on, you know, people putting them to work straight away. So that's just a bit of a snapshot into the automotive industry, and the secondary is stronger than the new car sales. We had some questions, and we've been having discussions around electric vehicles. So we're not seeing too many through our yards, but just having a look at some of the data around electric vehicles. So in 2018, they sold a bit over 2,000 electric vehicles. That's excluding hybrids. 2019 popped up to about nearly 8,000 electric vehicle sales. And in the first half of 2020, sales were up 56%. But just to put that into context, it's still, electric vehicles still only represent about 1% of the new car sales market. They're expecting a bit more demand for these vehicles as new supply comes on and new models. What's interesting also too is just thinking about the global or the international market. I referenced Toyota earlier, so one of Australia's biggest car sellers, they're expecting that more than half or around half of their new car sales by 2025 will be electric vehicles. And then I had a look in Norway, so they've got the highest penetration of electric vehicles at the moment, and they're looking to actually ban the sale of petrol, diesel, and hybrid vehicles by 2025. So that's not too far away. So we really want to watch this space. I know, talking to some financiers as well, they've been funding a few electric vehicle buses or EV buses. So might be another topic that we can look at the next webinar. So in summary, across all asset groups in the quarter two, April and May were the most impacted by COVID. Supply delays from overseas have led to buoyant secondary markets across various assets, but in particular the trucks and vehicles. Road transport and logistic industries remain strong. Goods still need to be moved across the country, so that's helping that sector. As James mentioned, the agri sector has been quite resilient and fueled by the favourable conditions, including the rain. Aaron covered off on, the aviation is struggling with a high level of uncertainty at the moment. So getting the crystal ball out, having a look, the government subsidies, banking support and insolvency extensions should continue to buoy the economy until early 2021. And speaking to people around the industry, that's what they're expecting. People are saying we're kicking the can down the road. Subject to no further significant spikes in COVID for the rest of the year, we would like to think that the market will still be subdued but fairly stable, at least to the end of 2020. And I think that the fireworks may begin in early 21 when some of these restrictions start easing and people are having to look at their commitments and where they're actually standing. That brings us to the wrap of the webinar. So look, I really want to thank you everyone for joining us. Sorry we didn't get to all of your questions, but we will respond to those. Please keep an eye out for our next webinar. If there's anything you'd like to cover off or like to talk to, we're happy to do so. And as always, please feel free to reach out to your local Slattery contact. Wish you all the rest. Have a great day and look forward to catching up soon. Thank you all.